Hello, trader Steve Gans here, and I just wanted to give a quick update on this hedge trade. So, as you may recall, a few days ago on April 10th, I came in, and if we take a look at SPY on April 10th, that would be this bar right here. I felt like our market was probably not going to get back above 550. I say our market, meaning SPY. So I wanted to put in a hedge trade. My premise was that the market's likely to go lower, not higher from here. Possibly even testing those recent lows, maybe even breaking those recent lows. Bottom line is I see no catalyst right now that's making our market go higher. Of course, we got this big rally off of a reduction in tariffs. But at the end of the day, things are very on again, off again. The news on a daily basis is likely to make the CEOs of companies a little bit edgy, if you will. And when they start coming out, giving their earnings forecasts, I think we're going to see their earnings forecast to be pretty muted because they don't really know the environment and how it's going to change or how quickly it's going to change. So I think they're going to very much hedge their bets. So that was my premise for thinking that our market's more likely to go down than up from there. So I shared a hedge trade on the 10th. And this hedge trade, I'm going to come out here to expiration so you can see what this is all about. So I sold a call spread above where I thought the market was likely to go. Again, I was thinking that, well, we probably aren't going to go above 550. I could have sold that call spread at 550, taken in more premium, but I gave myself a little buffer. I sold it at 560. Then I used the funds that I picked up from selling that call spread to come and buy some puts. Now, I only bought 2 puts. I sold 3 call spreads. I could have played with this a bunch of different ways, and if you go back and look at that video, you'll actually see that I did do exactly that. I played with a bunch of different scenarios, but my premise is if the market stays between 560 and 520, so that's a 40-point swing, pretty wide, that I will end up at expiration coming out of this trade with $379 in profit. If, however, our market sells off significantly, I can generate nice profits off of this trade. So what's happening at this stage? Well, if I come back here to today, I can see that we are in fact getting that sell-off, and that is bringing some decent profit into this trade. Now, the goal of this trade was not just to put it on and take it off for a profit. The goal of this trade is to act as a hedge against long-term buy and hold positions that I own. So while my Amazons and my Apples and my Microsoft and my Nvidia, etc., are taking a hit today, this particular trade is obviously gaining in profits and hedging those other positions. Now, obviously, I, as a trader, would need to decide how many of these I want on, how much am I looking to hedge. I just did this in a very small lot. When I do these, I tend to do them significantly larger because of my account size, but this is for demonstration purposes to show you the concept of how this works. So now that this is going in my favor, I don't want to take the trade off, but I could potentially come in here and take a look at, I sold these for $16.53, and they're currently trading for $10.37. I could thin out some of these call spreads if I wanted. In other words, I can buy those back, reduce my risk to the upside. If the market were to, in fact, bounce back above 560, I could take out some of this risk up here. I'm personally not interested in doing that. I don't see our markets going up there. Again, I don't see anything that is going to drive us higher than this point right now. And again, in fact, I see us coming back down to here over the next week and probably chopping sideways and then maybe dropping through. That is my personal expectation. But the reason for doing this video right here, right now, is I did want people to see conceptually how this trade works. The fact that these that we sold short are less valuable. We sold them at a higher price. We can now buy them back at a lower price. So that is generating profit. Then these two long puts that we bought, back when I bought those puts, I paid $19 for them. Those puts are currently worth about almost $26. So they're gaining in value. So I just wanted people to understand kind of how this trade works. And when it starts to play out as I had hoped and predicted, this is what I was wanting to see. And now I can make decisions about, do I want to do anything to manage it? Again, I personally am not going to at this stage. But if I wanted to, if I was going to do anything, I would probably reduce some of my call spreads. And in fact, at some point, I could even totally eliminate those call spreads. I could take those totally out of the mix and potentially end up in a trade here within a week or two that basically just has this configuration. And all of this would be gone if I am fortunate enough for the market to continue down for this trade to where I can take that call spread off for next to nothing. So hopefully that makes sense to everyone. If you like this sort of content, please like, subscribe, give me a thumbs up. And of course, always feel free to give any comments below as well. Take care, everyone.